Now, having understood what are forwards, let us try and understand what are stock futures or future contracts. Alright. So let us say today is 1st of April 2021, just hypothetically for the sake of understanding. And today the shares of Tata Motors are trading at $20 a share at the stock exchange. Tata Motors is an automobile company, alright? And let us imagine a notional basket, an imaginary basket containing 1000 shares of Tata Motors. Just an imaginary basket, alright? It's not a real thing. So if the Tata Motors share is costing 20 rupees a share, then this basket of 1000 Tata Motors shares will be valued at $20,000, isn't it? Okay. So this single share of Tata Motors is called as the underlying asset. And since this notional basket derives its value from the share of Tata Motors, because if the value of the share or the price of the share goes up, then the value of this basket goes up. And if the price of the share goes down, then the value of this basket goes down, an imaginary basket. So therefore, this imaginary basket is called as a derivative of Tata Motors shares because it is deriving its value from the shares. We are not saying whether it is a future or an option. At the moment, we are just saying it is a derivative. It could be anything. All right. Now, if something is to be traded in the market, then there has to be a buyer and a seller. If you want to buy something and if there is no seller for that thing, then you cannot buy. And similarly, if you want to sell something but there is no buyer for that thing, then you cannot sell. So for a transaction or a trade to happen, there has to be a buyer and there has to be a seller. So let us consider that there is a buyer and there is a seller in the market for this notional basket which does not exist in reality. All right. Now the buyer believes that the price of Tata Motors share is going to increase in the days to come. And therefore, if the price of the Tata Motors share increases, the value of this notional basket will also increase. Therefore, the buyer wants to buy it. And on the other hand, there is a seller who believes that the price of this Tata Motors share is going to go down in the future or in days to come, and therefore the value of this notional basket will also go down. So he wants to sell this notional basket. Remember, this notional basket belongs to no one, all right? It is just an imaginary thing. So the buyer tells the seller that I understand this notional basket does not belong to you, but still if you are willing to sell it, then I am willing to buy that imaginary basket now at $20,000. If the price goes up, I gain, and if the price goes down, then I lose. All right. At the same time, the seller tells the buyer, okay, I know that the notional basket does not belong to me, but still, if you are willing to buy, then I am willing to sell that imaginary basket at $20,000 now. If the price goes down in future, then I gain, and if it goes up, then unfortunately I lose. All right. So now both of them enter into a mutual promise. The buyer is promising this to the seller, and the seller is promising this to the buyer. And this promise is called as a futures contract. See, nothing has been exchanged. This basket is only imaginary. They have just exchanged a promise, and that promise is called a futures contract. And how long will that promise remain valid? That promise remains valid till the expiry date. And let us say that 29th April 2021 happens to be the expiry date. So on 29th April 2021, this promise will expire, and this imaginary basket, which as it is not there, will be forgotten. Alright. So now let us see what happens on 29th April 2021. The buyer and seller have now entered into a contract, a futures contract, by exchanging a promise. Alright. So now let us see, the buyer and the seller are there only. On 29th April, we find that the price of this Tata Motors share has increased from $20 to $21, and therefore the notional basket's value has increased from $20,000 to $21,000. So what has happened in reality? The buyer has gained $1,000 because he had bought at 20, now it has become 21. So he has gained $1,000. But the seller has lost $1,000 because he had sold at 20, now the price has increased to 21. So he has to repurchase at 21. Alright. So he has lost $10,000 or $1,000. I correct myself. Now let us imagine a situation that suppose instead of increasing, let us say the price had come down to $19. The price of this underlying asset or the Tata Motors share had come down to $19. In that case, the value of this notional basket would come down to $19,000, isn't it? So what happens now? The buyer loses $1,000 because he had purchased at 20. Now the price has come down to 19. So $1 per share, that means $1,000 over this basket he has lost. And what happens to the seller? The seller gains 1,000 rupees because he had sold at 20. Now the price has become 19, so he can repurchase at 19. Alright, he has gained $1 per share. That means he has gained over this basket $1,000. Alright, and what happens in either of the case, whichever party wins, whichever party loses, the promise ends on 29th April and this future contract expires. Alright, and this notional basket, which never existed in the first place, it just vanishes into thin air and is forgotten. And ultimately, this future contract is a zero-sum game. Why zero-sum game? Because whatever one party gains, the other party loses. Irrespective of if one party is gaining, the other party loses. Now imagine a situation that on 29th April, the price of the underlying asset, that is Tata Motors share, would have remained 20. So in that case, the buyer would have been at a no profit, no loss state, and the seller also would have been at a no profit, no loss state. What I have explained to you now is basically a futures contract or a stock futures. I have not explained to you as to how it is traded. In the next lesson, I will explain to you conceptually how a stock future is traded, and once we understand conceptually how it is traded, then we will see an actual trade, how a trade is done. Alright.